Today's video is on DIVO, AMPLIFY Enhanced Dividend Income ETF. It has a 4 to 5% dividend, and it's going to not add much to our income as we buy this fund today, but it will round out some of our stock exposure. So as you can see, we're making $116,000 in dividends per year. But if you go down to our stock section of the portfolio, which I'll try to scroll slowly on, you'll see that the stocks start here. I keep $1,000 in all of my riskier names. So let's say something like a Whirlpool. You see on the right-hand column, $1,000. So $1,000 in these various stock funds that have nice dividends that are in the S&P. SLG was formerly in the S&P, but Boston Properties, we used to have that. We sold that for the gain. Whirlpool, Mo, Devon, these are all blue chip S&P names, and DIVO is a basket of those names. If you go to the portfolio of DIVO, you'll see that it has some of the best companies out there. And one of the top holdings of it is Microsoft. So I thought that was an interesting way to play Microsoft because it's 5% of the assets. And yet, and McDonald's too, McDonald's has been on a tear. And yet, if you notice on the chart of DIVO, it's pulled back. So yes, it only has a 4.7% dividend, but if you go into its chart and you see where it's at, you'll think differently of the stock because it's at the 200-day moving average, as you see here, 200-day moving average. So even though the yield is low, once again, this is a 5-star fund, which I'll show you in 1 second on Morningstar, but it has also pulled back to the 200-day moving average, this orange line. That's where investors, especially long-term investors and traders, both look to start long positions. So this fund has tagged the 200-day moving average 3 times, in fact, 1, 2, and 3 there. And this lowest point here on the 200 coincides with the highs of 2019. So that's a healthy pullback. That's exactly what you want to see, higher highs and higher lows within the max time frame chart. And again, you saw the portfolio full of top names in the S&P: Microsoft, McDonald's, Visa, JP Morgan. Very well diversified, it looks like, because you have tech, you have consumer cyclical, you have defensives, energy, just to name a few there, financials. So if you go to DIVO's Morningstar test, you'll see that it has a 5-star rating, which is excellent. And on a $10,000 test, it made you $22,000 since its inception, which looks like was around 2016. Between 2016 and 2017, this fund launched. So it's doubled your money from $10,000 to $20,000. It doubled your money in about 7 years. So that's very impressive. And again, it's pulled back on its chart. So why wouldn't you add to DIVO here if you already own shares? For me, I'm going to go ahead and initiate the position. This was brought to me by a subscriber, which I really appreciate. Really appreciate all my subscribers for sending me these ideas. And with DIVO, I've always known about DIVO, actually. It's just that it had such a low dividend, it never had enough of a yield to get me interested. But now that it's pulled back to its 200-day moving average, which I showed you on the chart, I feel like now is the time to buy DIVO. Plus, if you want to play Microsoft again and you feel like you missed that trade, DIVO's largest holding is Microsoft, so it gives you an indirect way to play Microsoft there. So I'll add to DIVO on any dips. It's also a place that I can sell from and raise cash if I ever need to raise cash, because our margin now is up to $242,000. As we also added to another name today in the portfolio, which is Clip, and that has a 50% dividend. Clip here. We have 7,000 now. I want to get it up to 10,000 because Chinese tech companies are cheap. And by the way, I increased my Clip hedge with Yang. Yang doesn't do Chinese internet. It's just all of China. Yen and Yang are the pairs on this. The short is Yang and Yen is the long, which I have a sold put on here. Yen, which we made $2,000 for selling this put, $1,900 for selling one put on Yen at 50. So I have that hedged with Yang, but also I added to my Yang hedge today just a little bit Because if all China falls, so will the internet tech names. You know, if we have an interest rate issue, then maybe just tech will fall and growth because they're affected by interest rates. But if all of China fails, then that short should kick in and help me some. So that's how I got my income up to 116,000, because yesterday, if you saw our past video, we were at 114,000. So yes, Devo added a little bit of income. It added about $50 of income. You know, we're not really playing this one for the income. Also, I like higher income names, as you know. The main reason actually is because they qualify as income and as a pay stub to banks. They act as qualifying income to banks. And Devo doesn't really provide that for me. But it's cheap on its chart, and I think there's a chance just to take it up for a couple of points back to the old highs and take it for a quick trade. That's why I'm in it. The dividend is just not enough for me. Anyway, we are beating the market with this strategy. We're up 15.9%. The Dow's up 1. The S&P is up 7, and the Nasdaq's up 15.8. So we're beating the Nasdaq by a hair using the strategy of margin and dividends. The dividends just pay back the margin. My margin's 240 now, but if we collect these dividends in less than 3 years, my margin will be paid back. The interest on my margin is so small that the dividends I earn from these funds make the margin trades worthwhile. They make it viable. So if I'm getting 20% dividend on Cornerstone and I'm getting charged 5 to 6% on margin, I'm still netting 15. Whereas with Devo, I'm breaking even because my margin is 5%, and so is my margin interest is 5%, so is the dividend, so I break even. Not bad. It beats my margin interest, so I'll take that, and it'll potentially give me some share price appreciation in the meantime because it's at the 200-day moving average. So I hope you like this video on Devo. If you have any other ideas, please leave them in the comment section below, and I'll talk to you soon. Thanks.